The market is sending two completely opposite signals right now. You've got euphoria on one side and a minefield of risk on the other. So let's figure out which story is the real one. What we're seeing is a full-on collision course. You have this relentless buy-the-dip crowd pushing a rally, and it's running straight into very real global conflicts and a fast-approaching trade war deadline. Something's got to give, because these two forces can't both be right. So, for us as traders, it all boils down to one thing. Which side is going to break first? The goal here is to walk through the key levels, the data, and the scenarios you need to be watching. That way, you're positioned for what's coming, not just reacting to it. All right, first up, the geopolitical chessboard. These are the macro risks that you simply cannot afford to ignore. These are the kinds of things that can blow up any technical setup with a single headline. You can see the escalation playing out step by step. It started with rare earth minerals, then soybeans, and now we're staring down the barrel of huge tariffs. That November 1st deadline, that's the key date to circle on your calendar. It's the catalyst that's going to force a move and pump a ton of volatility into this market, guaranteed. And look, this isn't just about China. The risk is everywhere. You've got a potential energy crisis brewing with Russian refineries getting hit. You've got instability in Venezuela, which is an OPEC member, and of course the ongoing conflict in the Middle East. Every single one of these adds a risk premium to the market, especially when you're looking at oil. Okay, so we've talked about external risks. Now let's pivot and look at a huge structural problem right here at home. This isn't some potential headline. This is a fundamental balance sheet issue for the entire U.S. economy. $37.5 trillion. Just let that number sink in for a second. That's the U.S. national debt. It's so massive that it's basically a permanent brake on economic growth. So this leads to a pretty scary concept called the debt-death spiral. Here's the bottom line. When the cost to pay your debt grows faster than your economy, you're in trouble. The government is eventually forced to inflate the currency just to make the payments. It's basically a monetary reset. And in that kind of environment, you see people flock to hard assets. Think gold. Okay, so if we've got all this geopolitical risk and a massive debt problem, why is the market so darn euphoric? This is the heart of the contradiction. Let's dive into the market internals and see what's really going on under the hood. This right here just perfectly shows the market's split personality. The bulls will point to healthy things, like money moving into small caps. But the bears, well, they're pointing at some serious red flags. Retail margin debt is through the roof, and even the big fund managers are calling out an AI bubble. It feels like a tug of war, and the rope is about to snap. And here's the data to back it up. This chart shows just how convicted the retail crowd is. According to Bank of America, we just saw the fifth largest buy-the-dip inflow since 2008. Now, this isn't just a little bit of optimism. This is extreme bullishness, extreme leverage, and historically, when the retail crowd gets this one-sided, it's often a major warning sign for what's coming next. All right, let's get more granular. We're going to zoom in from the broad market to the specific sectors where this fight is happening. These are the key battlegrounds you need to be watching. Really, three sectors are telling the story right now. First, semiconductors. They're the canary in the coal mine for the whole market. How they react to earnings is going to be critical, especially with that huge institutional dark pool trade we just saw. Keep an eye on 330 for support and 348 for resistance. Then you have energy and defense. These are just pure plays on all that geopolitical tension. If things heat up, you can bet these sectors will move. Okay, time to put all the pieces together into some actionable scenarios. We've looked at the big picture risks, we've looked at the market's internal conflict, so how does this play out? Here's what I'm watching for. All right, first, the necessary disclaimer. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice. So my base case, the most likely outcome is that we're stuck in a choppy, volatile range. The market is just coiled like a spring, pinned between the bulls and the bears, just waiting for a catalyst to break it one way or the other. And that trigger? It's going to be big tech earnings or that November 1st tariff deadline. Now, for the bull case to play out, the trigger is very specific. We need to see the semiconductor index break and hold above 348. If that happens, it's a green light. It means the institutions are buying in, and you could see a massive year-end rally as all that retail FOMO kicks in. On the flip side, the bear trigger is a break of 6,600 on the S&P 500. If we lose that level, look out below. It could kick off a negative gamma loop, which basically just means dealers are forced to sell, which causes more selling. It would be a clear sign that the macro fears have finally won the argument.
So with so much uncertainty, but with such clearly defined trigger points, how do you actually trade this? Let's walk through a specific, defined risk example.
Here's one way to think about it. The thesis is simple. Hedge against that big November 1st deadline. A potential structure could be a protective put debit spread on an ETF like SPY. All this does is give you downside exposure with a defined risk. You're trying to profit from a drop in the market and a pop in volatility, but your max loss is capped at what you paid for the spread. And your invalidation is just as clear. If we get a trade deal or the market breaks that key resistance level, the thesis is dead. And one last time, the final disclaimer: not trading advice, just a market update to keep you informed. Markets carry risk. Trade your plan, manage downside, and verify all data. So I'll leave you with this. Retail leverage is at an all-time high. Institutional risks are flashing bright red. The market is absolutely coiled for a big move. The question you have to ask yourself is, are you positioned for the breakout, or are you prepared for the breakdown?